India sells nearly 2 crore two-wheelers every year, making it one of the largest motorcycle markets in the world. Behind every motorcycle is a small mechanical component that keeps the system moving, the transmission chain. One Indian company has built a dominant position in this niche, supplying both vehicle manufacturers and the massive replacement market through its Roland brand. India currently has over 25 crore two-wheelers running on the road, while another 2 crore new vehicles are added every year. Because transmission chains require periodic replacement, this creates recurring demand from a large installed base of vehicles. Hello, I am Sebi George, and this is Decoding Equity, where the companies are analyzed through numbers and not by noise. Today, we are analyzing LG Balakrishnan and Rose Limited. LG Balakrishnan manufactures transmission chains, sprockets, and chain kits used in two-wheelers, three-wheelers, and industrial applications. The company supplies both to the vehicle manufacturers and replacement market, where the aftermarket typically offers better margins. Looking at the quarterly sales, revenue increased from 581 crore in December 2022 quarter to around 817 crores by December 2025 quarter. Despite fluctuations, the overall trend reflects improving demand from both OEM production and the replacement sales. Operating margins have remained stable between 15 to 18% over the recent quarters. Although there was a brief dip during the mid 2025, margins recovered in the September quarter, indicating the effective cost control. Looking at quarterly profitability, net profit increased from about 72 crore in the December 2022 quarter to around 88 crore in December 2025 quarter, reflecting steady improvements. Before we go deeper into the company's financial strength, if this style of analytical breakdown adds value to you, consider subscribing. I publish structured company research regularly for serious investors. Now let us look at how efficiently the company generates return from the capital invested in the business. Over the last 5 years, return on equity moved from about 15% in FY21 to around 16% in FY25. Meanwhile, return on capital employed peaked near 26% in FY22 and moderated to around 20% in FY25 as the company expanded its capital base. Even after this moderation, return ratios remain healthy. Another important question is whether the profits are supported by actual cash generation. Over the last 5 years, LG Balakrishnan has generally generated operating cash flows close to or higher than the reported profits. For example, in FY24, the profit was about 271 crore, while the operating cash flow was around 343 crore, indicating strong earning quality. The company also maintains a strong balance sheet with debt equity ratio remaining very low at around zero point zero 0.07 to zero point 0.1. Looking at institutional ownership, foreign institutional investor holding declined from about 9.2% in March 2023 to around 7% by December 2025. Meanwhile, domestic institutional investors increased from about 11.7% to roughly 12.9%, while promoter holding remained broadly stable around 34 to 35%. Working capital efficiency remains stable. Debtor days are around 45 days. Inventory days improved from about 160 days in FY22 to around 140 days in FY25. And the cash conversion cycle reduced from roughly 113 days to about 93 days. LG Balakrishnan domestic sales account for 75% and exports its produce to more than 70 countries. The United States is one of the largest export destinations, along with Europe, Latin America, and parts of Asia. The company has maintained a dividend payout ratio of around 20%, balancing the shareholder returns with reinvestment. Book value growth also reflects the value creation. Company reserves increased from about 848 crore in FY21 to nearly 1,873 crore in FY25. Looking ahead, growth will depend largely on the two-wheeler industry outlook and the continued strength of the replacement market, while expanding exports provide additional opportunities. However, certain risks remain. A slowdown in the two-wheeler industry, steel price fluctuations, or increased competition could affect margins. This video is intended purely for educational and analytical purpose and should not be considered as a recommendation to buy or sell the stock. The company has demonstrated steady growth, stable margins, strong cash flows, and healthy return ratios, supported by disciplined balance sheet and expanding exports. Thank you for watching. This is Sebi George from Decoding Equity, signing off. See you in the next analysis.